Blockchain technology has allowed permissionless networks that everyone can use, with built-in economic incentives ensuring that network services can be maintained eternally without the assistance of any single firm or central authority. Similar to how Internet protocols enabled a Cambrian explosion of network applications and services that is still ongoing today, blockchain networks are enabling an increasing number of existing services to be provided in a more decentralized manner, without reliance on central authorities or intermediaries. The financial services industry is one business segment that is seeing tremendous innovation as a result of blockchain. Decentralized finance, or DeFi, refers to blockchain-based alternatives to traditional financial services. Disclaimer: I'm not a financial advisor. The video is for informational and educational purposes only. Hey everyone, welcome to Crypto Trends. In today's video, we'll talk about DeFi, so make sure to subscribe to the channel so you don't miss out on any of our videos. So, without further ado, let's get into it. What is DeFi? Decentralized finance, or what we usually refer to as DeFi, is a developing digital financial infrastructure that ideally eliminates the need for financial transactions to be approved by a central bank or government agency. Many consider DeFi to be an umbrella term for a new wave of financial services innovation. It is deeply connected with blockchain, the decentralized, immutable public ledger on which Bitcoin is based, which allows all computers, or nodes on a network, to keep a copy of the history of transactions. The concept is that no single entity has control over or can manipulate the transaction ledger. How DeFi works? DeFi provides financial services using cryptocurrency and smart contracts, eliminating the need for intermediaries such as guarantors. Lending, in which users can lend out their cryptocurrency and earn interest in minutes rather than once a month, receiving a loan instantly, making peer-to-peer trades without a broker, saving cryptocurrency and earning a higher interest rate than a bank, and purchasing derivatives such as stock options and futures contracts are examples of such services. Users employ dApps, the majority of which can be found on the Ethereum network, to allow peer-to-peer commercial transactions. Coins, Ether, Polkadot, Solana, stablecoins, whose value is pegged to a currency such as the US dollar, tokens, digital wallets, Coinbase, MetaMask, DeFi mining, also known as liquidity mining, yield farming, staking, trading, and borrowing, lending, and saving using smart contracts are among the more popular DeFi services and dApps. DeFi is open source, which means that protocols and apps are potentially available for people to investigate and improve. As a result, by designing their own dApps, users may mix and combine protocols to uncover new combinations of potential. How do people make money in DeFi? People are seeking to capitalize on the expansion of DeFi in a variety of ways. Using Ethereum-based lending apps to generate passive revenue is one option. Users essentially lend their money and earn interest on the loans. Another approach being employed is yield farming, which is a riskier activity used by more sophisticated traders in which users search through a plethora of DeFi tokens in the hopes of discovering prospects for higher yields, but it is difficult and can lack transparency. How risky is DeFi? DeFi, like many other new decentralized blockchain networks trading in cryptocurrencies, is extremely hazardous, especially given that it is based on a new technology that tries to destroy an established institution, such as a centralized bank. It's much riskier for newcomers who are enticed by the potential profits of yield farming and passive income. Because there are greater potential threats, Ethereum provides security and fraud avoidance recommendations. Fraud and criminality remain important issues. $14 billion in Bitcoin was transmitted to illegitimate addresses in 2021, roughly double the level observed in 2020. In 2021, around $2.2 billion was directly stolen from DeFi protocols. While the data reveals that cybercriminals earned $7.8 billion in cryptocurrencies from victims, around $2.8 billion of the total came through a fraud known as rug pulls. Developers in these scams construct seemingly credible crypto ventures before taking investor funds and leaving. You should be cautioned that many recent assaults on DeFi exchanges might be linked back to faults in the smart contract code controlling those protocols, which hackers exploited to steal cash. The most significant conclusion is to avoid new tokens that have not been subjected to a code audit. Code audits are a procedure in which a third-party business evaluates the code of the smart contract underlying a new token or other DeFi project and publicly validates that the contract's governance rules are ironclad and do not include any methods that would allow developers to steal investors' cash. What do you think of DeFi? Is it capable of disrupting existing financial institutions? Let us know in the comment section down below. With that being said, here we come to the end of our video. I hope you liked this video. If so, then don't forget to subscribe to the channel so you never miss any video. See you in the next video. Till then, take care. Thanks for watching.